I was going to upload a video talking about Lemonade stock since they just opened yesterday early registration for auto insurance and what that means for the company. But yesterday at 4 p.m. I was on my car driving, listening to music, and suddenly I got a notification from Robinhood saying that Netflix was down 10%. 10%. That is insane for this company, and I immediately knew they announced earnings and something went wrong. And that is what we're going to talk about today. Hello everyone, welcome back to the channel. Today we are going to talk about Netflix stock again, their earnings, and what we should expect from the company. Please consider subscribing and smashing that like button since it really helps the channel out. Also, I opened a second channel, so I post the same content that here but in Spanish. So if you or anyone you know understands or speaks Spanish, it would mean the world to me if you go and subscribe and share the channel. But let's start with the video. First of all, they show this excellent chart that it already shows a forecast for next quarter. If we take a look at this, we can see that revenue had an excellent growth. To be honest, they reported $7.16 billion, beating analyst expectations with a 24% growth. On my Monday video, I said that I expected a 25% growth year over year for the whole 2020. So having a nice 24% growth for the first quarter is actually very nice in my opinion. Then operating income is very strong in my opinion, being the highest in many quarters. It grew 27% for the quarter, which is actually excellent since the highest they have had was in quarter 2 2020, where they reported a 22.1%, and still are expecting a nice growth for quarter 2 2021 of 25%. In my opinion, that is an excellent margin for Netflix, to be honest. Then their net income increased massively. They reported $1.7 billion in their net income for the quarter. That is $1 billion above in comparison to quarter 1 2020, and still even more quarter over quarter, and are still estimating for quarter 2 to double what they reported in net income for quarter 2 2020. Then diluted EPS, you can see the same. Obviously, it more than double quarter over quarter and year over year, and that is impressive, and still the stock went down over 10% after market. Why? Because of this global streaming paid membership. You can see that the year over year growth decreased to 13.6% when they would tend to report an over 20% growth every single quarter. But we do need to take into consideration that 2020 was extremely huge growth for them. They only had 3.98 million global paid net additions and are expecting only 1 million for quarter 2, which obviously investors did not like that at all, because they started thinking that Netflix will start fluttering down. Now, Netflix believes that paid membership growth slowed down to the big COVID-19 pull forward in 2020 and a lighter content slate in the first half of this year due to COVID-19 production delays. Obviously, it is not easy to see this kind of charts basically saying that their growth is decreasing, but I think we need to take into consideration other kind of factors. Now, let's see the regional breakdown. Revenue came in nice, kind of flat, but it is okay for the US and Canada region. Same happened with paid membership, it was almost flat. See how they did see nice growth for quarter 1 and quarter 2 2020. Because of the pandemic, everyone was at home, everybody would need something to do, and Netflix was an excellent option. Then their average revenue per membership actually increased 9% for the first quarter. The question is, how much can they raise that in the future? I do think a lot of people are willing to continue paying for Netflix service, but it will not be easy for them to increase prices that much there in the US. If they can't keep rising the price, then they might have to pivot into other business models. As I said, they should definitely start offering live streaming, sports streaming, or esports streaming. I think that is what will get them to another growth level. Then the EMEA, which is Europe, they did see a huge acceleration in revenue, paid membership, and paid net additions in quarter 4, but a slowdown in quarter 1 2021. Revenue still came strong because they were able to increase average revenue by 11%. So basically they raised the price but saw a slowdown in net paid additions. When When you raise the price too much, people start canceling and getting something cheaper or stop getting new subscribers. But still, they were able to see a nice growth in paid memberships. Then for Latin America, the revenue was kind of nice, kind of flat. Paid net additions actually decreased and their average revenue per membership decreased 8% in comparison to Q1 2020, as Latin America is more price sensitive. It used to be $8.05 and now it is $7.39. Why? Well, the Latin America market is way different than the US and Europe because of the purchasing power. The average wage in the US and Europe is way better than in Latin America. I could talk for hours about this and even more since I'm from Venezuela, but the income is different. So in Latin America, a $2 raise in price might mean more than a $2 raise in price for the US. That is in my opinion. Lastly, the Asian Pacific region saw a way better revenue growth, but still a decrease in paid net additions. Still, they were able to raise their average revenue per membership by 9% as well. Now, something I did want to mention is their income statement. We already saw that their revenue increased 24% year over year, but you know what impressed me? Their cost of revenue. It decreased. Even though their revenue increased, their cost of revenue decreased. Same with marketing expenses. Their technology and development and general and administrative expenses did increase but stay almost flat, which impressed me since they were able to report an operating income of almost $2 billion. That is more than $1 billion in comparison to Q1 2020. Because of that, they reported a massive net income of $1.7 billion. And when you have such an excellent net income, obviously, you will most likely have an excellent cash flow. Way better than Q1 and Q4 2020 cash flows. Obviously, we have to take into consideration that during 2020, they had to halt production of many shows, which means that they spent way less money than normal. Now, this is something that confused us investors. Why is Netflix down 10% if they had excellent numbers in net income, revenue, operating income? Basically everything, because investors don't care about that. They don't care about net income or revenue because if not, the stock would have been up 10% and not down 10%. Investors care about growth, memberships growth. Now, on their balance sheet, their cash and cash equivalents stayed almost the same. Saw a teeny tiny increase, so they have $40 billion in total assets and $27 billion in total liabilities. They do have a kind of a big long-term debt, but decreased by $1 billion since December, which is kind of nice. It is normal because they have to finance a lot of shows, which is very, very expensive, but this is normal for a company like Netflix to have a huge debt. Now, we knew that the pandemic was going to have an impact, and even more with this kind of big companies, since as Netflix gets bigger as a company, it becomes more difficult to continue having such growth in membership. Also, we need to take into consideration that Netflix do not believe that this decrease or slowdown in growth was due to competition because, as they said, we don't believe competitive intensity materially changed in the quarter or was a material factor in the variance, as the over forecast was across all of our regions. And that is why they know the slowdown was not because of the competition, and they are not concerned because of the competition. They missed at the same rate all around the world, in Europe, USA, and Canada, Latin America, and Asia Pacific, even in places where there are no competitors. So there is no way of explaining it was because of competition. But we have to take into consideration that they gained a lot of subscribers not spending money in content, and also they lost several shows like The Office, which was a very popular one within the platform. Now, even though I don't look that much to graphs, I do have to say that Netflix is a very volatile stock, even though they are a big company. Netflix is a long-term investment unless you like the adrenaline. And I'm saying this because let's take a look at their chart. Even though in the long term, it has had a nice performance, if we zoom in on a yearly basis, we can see these ups and downs that are very huge. Up over 23% and certainly down over 13%. Then I get up and then down 11%. And that is how it has been with Netflix. Even though the company has had excellent growth in 2020, the stock was very, very volatile. So with all that said, I want to say that I'm not concerned about this dip. I think it is a buying opportunity for the long term because I believe in this company's growth, and I think they will continue innovating, and also know that they will come out with very different TV shows that they were not able to do in 2020, since I think that was the main cause of why many people canceled or just didn't subscribe. As I said in my last video, even though Netflix might be losing market share because of competitors like Disney Plus, they are not losing customers, and that is normal to see in any industry. There is always the leader company in the industry, the pioneer with the service, until others start copying or start doing kind of the same. What do Netflix has to do? Continue innovating, creating excellent content, and maybe think about diversifying into other businesses. That was everything on Netflix. Hope you enjoyed the video. Thank you, and see you next time.